Hi, this is Randy Finney with Right Side of the Chart, and today is Saturday, August 4th, 2012. Today I'd like to do an overview of the global markets. My primary focus here will be on the U.S. markets. I think we're at a pretty important technical juncture here, and from time to time I like to do these video overviews when we are at those type of levels, as I feel there's a lot more that can be discussed and covered in these video and audio updates versus trying to put up the static charts. With that being said, I'll try to make some static charts after this video and post those on the site as well for reference. Okay, let's go ahead and get started. And what we're looking at here is the SP 500 SP 500 monthly chart, monthly time frame, and a couple things to note. I've done several videos on this chart recently in the last few months. Remember, a monthly chart, you're not going to see day-to-day changes from that. Changes will be rather slow, but let's go ahead and take a look here. Highlight this line that I'm highlighting. This is a key primary uptrend line, started back all the way back in the bear market of 74, and as you can see, we've had second touch here, third touch here, and on the lows in 2009. It takes two tags to start a trend line and a third to validate it. So we have a pretty valid long-term trend line here to watch. And the yellow lines here, this is a parallel downtrend channel that we're watching. So if you look at prices, let me go ahead and zoom in. You can see that we're getting very close to that downtrend line, this yellow downtrend line here to the top of the channel, and not far above that we have this horizontal, so far, double top high. And let's zoom out real quick and take a look at that. You know, a double top pattern, when you have two successive peaks like this on a stock, works on just about any time frame. Most commonly you see these on the daily or the weekly time frames, but this is a large double top on the monthly pattern, and the bottom of that double top pattern would be this line here. So this is a long ways away, more than likely, if prices were to turn down, assuming they turn down, but that would be a break of the double top pattern and project a whole lot lower. Obviously we don't need to worry about that too much right now at this point in time. Let's take a look at where we're at again. These other lines, I have multiple uptrend lines. A lot of these will show up on my daily or weekly charts, and you know, as you can see here, this was the first trend line that broke back in the 2007 to 2009 bear market. Prices broke down, then we hit this other uptrend line here, and then the real selling, the cascade selling started. And of course we have similar what I call sub uptrend lines within the larger pattern here, and as you can see, this orange uptrend line we're resting on now, and we'll take a look at that on the weekly and daily charts here in a minute. So something to keep an eye on. Most importantly, that we are coming up on key monthly resistance with this key primary downtrend line. This keeps the downtrend intact, which actually started back in the last bear market, which peaked out in late 2007. So until we take out that high, right now we're still making a series of lower highs, which is a downtrend. Of course, we can go up a little higher here, make a triple top, so we'll watch for now. One of the things that keeps this pattern bearish is the divergence. If you note down here, I'll zoom this in. We had some very strong negative divergence put in on that double top high. Yes, we did have a nice correction from there. Could that be it? All that's going to play out from that double top with that negative divergence? Possibly. Maybe we do go on to break new highs. But either way, the MACD continues to lag, and if you look, this trend line's been extended out. We continue to remain under that downtrend line. So the MACD is lagging or just keeping pace with this move. So let's go ahead and jump forward to the weekly chart. Same key downtrend line that we're watching, and of course, zooming in, you can see we have just a little bit of room. We have a little upside here to go, and just above that, here's that downtrend line. If we go just above that, we do have some nice horizontal resistance here. The previous reaction high back here where the cursor is, and several touches back here, either body or candlestick tail touches. So that's a key level there as well. And now if you take a look, let me go ahead and color code this line here. And what we're looking at is a larger rising wedge pattern. I'll put up a few indicators here. Let's put up the MACD and the RSI, and we'll even put up volume as well. Take a look at that. So if you look at this upper line right here, from this peak to this peak, you have a higher high. There's a peak right here in the S&P on prices. The next high, that's why you have this uptrend line here. And as you can see, both the RSI and the MACD, to stretch that MACD out, we had such a low here in 2009. It's kind of pulls the scaling off a little bit, but there is negative divergence across the board. We also have negative divergence on the volume, so as the market pushes up to make higher highs, we see declining volume. So pretty much negative divergence across this wedge, across the board, I should say, on this rising wedge. You know, we've had these other trend lines here in the past, which broke down, and they were valid. These were trend lines I had drawn, and we were watching, and you know, shorted each of these. But what makes this one different is this large and powerful divergence that we have in place now. We didn't have those the divergence in place on these other trendline breaks. Yet they did play out for quite a bit. Therefore, you know, my analysis is that if this key uptrend line breaks, we could see prices going quite a bit lower, even substantially lower than what we saw in these two previous corrections. Something I've mentioned in the past before is I'm big on divergences. Major tops, lasting tops and bottoms, not always, but most often come with divergences. If you look here, this yellow line that I'm highlighting, this is the sell-off down into the 2009 lows. Strong positive divergence in place there, and of course that divergence led to, you know, the subsequent rally there off the bottom. Here, if you look at this yellow line that I have highlighted here, you know, an upward sloping trend line, negative divergence in place there. Really the only negative divergence that we've had on the weekly MACD other than the current divergence, and you can see quite the correction there, including the flash crash. That started off with the flash crash, and then we had you know, some follow-up selling. So I'm big on divergences, and again, they're not absolutely necessary, but when you do have divergent tops like this or bottoms, it's time to take note and be ready for a substantial move. Of course, you need this trigger. Divergence in itself is not a sell signal. Many a times I've seen divergences get burned through. In other words, this MACD, as you can see here, is poised to make a bullish crossover, and that may turn up and continue on higher with the market making new highs, and then that negative divergence would be negated. I don't know if that's a double negative or not, but once the MACD takes out this peak right here, then you've negated, or I should say, if it takes out this peak, you've negated that divergence. Okay, that's probably about as clear as mud, so let me move on. And let's go ahead and hide these. Put these back. And one other thing I wanted to draw here, you note these, trend lines. They seem to be in a pretty clear order or succession. Let's take a look here. Something you play around, and here's some Fibonacci fan lines. Let's throw these fib fan lines on there, and I find it pretty interesting how this works out. I'll line this up with that, and you can see, of course, I've got to get the bottom right on there. You can see how they line up almost perfectly. I've done this before. I should have had these on the charts now, except the chart was looking a little bit busy. I've got so many trend lines down here, it's hard to see the bottom. I'll have to zoom in there. But I have played around with this, and if you line these fan lines up just with the trough here in the 2009 lows, they line up nearly perfectly with the current trend lines that I have on there. Okay, so I'll play around with those lines later, maybe put those up on the static chart. So, main things to keep an eye on, again, we're looking at a weekly chart here. This is the primary key uptrend line so far. Now we've had these 1, 2 touches, so let's see what happens here. I could easily see prices pushing up to this next horizontal resistance level, and even more so within this wedge. Here's that rising wedge, and as you can see, we still have plenty of room to go. If we extend these lines out, plenty of room to go before we hit the apex. Now, we usually don't make it all the way up to the apex within a wedge. Typically, patterns break down around 70-80% towards the apex. But either way, that's one possibility, and what we would see there if the markets decide to ultimately, of course, come down and break this uptrend line, this key uptrend line here, is it would look like a nice bull trap. We see prices punch above this uptrend line. That would probably usher in short covering, honestly, if there are any shorts left in this market after Friday's rally. But and of course, if we went over this line as well, that's another key resistance level being watched. So this would just be, have the potential, folks, for a being the mother of all bull traps. If we did take out these two levels here, went up to the top of the wedge, and then turn back down, because at that point we'd have a lot of new money probably come into the market on the long side, and the few remaining shorts that are left be taken out at that point. And when you have all the shorts cleared out of a market, that usually tends to take out a lot of support, and you can see those quick sell-offs. So something to keep an eye on. Okay, let's jump forward here, daily chart, and again, if we look at that downtrend line off the highs, we actually have on this one, 2, I'm looking at the top here, 1, 2, 3, 4, and now 5 touches. We're right on that, at least as I have it drawn here on the daily chart. So we're again at or near a key level in the markets. There are some overhead support levels, and this is what we want to keep an eye on. This large, called a large triangle pattern, almost a symmetrical triangle here. If you take this uptrend line from the 2009 lows and this downtrend line from the highs back in earlier this year, 2012. Okay, let's move forward and talk a little bit about the Nasdaq now. The Nasdaq, that's the exciting index. There's the index where we have, your big key companies like Apple and RIM, and well, not so much RIM anymore, Google, Intel, Microsoft. You have your volatility, your high beta stocks. And let's take a look here. A lot of people follow the NDX 100, which are the largest 100 stocks in the Nasdaq. And what do we have? It looks like a very bullish. There's a nice symmetrical triangle, and here's horizontal support, bullish breakout. That's as one would interpret this chart, and I can't argue that. Technically speaking, it is. However, as I've mentioned in the past, and most of you are aware, the NDX is, in my opinion, a very flawed index. It is extremely top heavy, its largest components, and of those large top 10 holdings, you have Apple with nearly, check the most recent data I could get was on the QQQ, the tracking stock for the NDX. As of August 1st, we were looking at almost a 20% weighting in Apple in the NDX. And as we all know, Apple's a once-in-a-lifetime stock. There's been stocks in the past, maybe U.S. Steel during the great building of the railroads back, around the turn of the century. We had GE, in the 50s and 60s. You had IBM. There's always been, these every generation will come along a stock that is just undeniable, and Apple has been that. It's great product line, it's an earnings juggernaut, and it's here to stay, at least in the foreseeable future. So with that being said, to have an index with a weighting that's 20% into what's widely known as the most successful company, in recent years, is now, I believe, the largest company by market cap. It's a flawed index, so I probably rambled on a little too much about that. So what we're going to look at here, I've mentioned before, are two things. We'll look at the NDXE. Here's the same components, the Nasdaq 100, largest companies in the Nasdaq, except the equal weighted index. And what do we have here? A very similar triangle pattern, not as steep. The downtrend line is a little more steep, of course, because this index has lagged. Because if you back out that heavy weighting for Apple, you don't have the performance. So and in this case, we have not yet broken above this key downtrend line off the highs. So I'm putting more stock into this. We have the SP 500, as I just showed, at right up against a key downtrend line, and now we have the NDX, the equal weighted Nasdaq 100, right at a key downtrend line here from the 2012 highs. And if you go back a few years, a couple of years, I'm sorry, let's see here. Yeah, that's the March around March, was that March 23rd or so highs. And if you go back earlier in the year, 2011 here, and there's July 2011, you have this key downtrend line. As you can see, we have 1, 2, 3, 4, 5 touches. Then once that downtrend line broke, we had it, prices broke above here, found support against it, bounced down, finally broke below, and has since bounced in this range and has continued to find resistance time and time again. 1, 2, 3, 4, and we're almost up that again. So what we're looking at, folks, plain and simple, is one key downtrend line here, another probably more important downtrend line off the highs here. The fact they come in together is pretty telling. Just over that, we have another pretty solid horizontal resistance level. So again, we're looking at most of these key US indices at or very near, just below some key resistance levels, and most of those indices have negative divergence in place to boot. Okay, let's take a look here at the NDX weekly chart, and I need to throw in the MACD. Clear negative divergence here on the MACD. MACD is has put in a very clean, nice turn down lower low against a higher high in prices. Again, we're looking at the equal weighted Nasdaq 100 index here. Okay, and finally, let's talk about the Nasdaq. Let's look at the Nasdaq itself, the Nasdaq Composite, and let's go back out to a monthly view. Okay, this chart, what we're looking at here, a monthly view on the Nasdaq Composite. So every candlestick represents 1 month of price action, and we'll go all the way back to 1991. Actually, a little before that. So 1990, we have this key uptrend line here. Prices found support back in 2002. Came and they finally succumbed and broke under that downtrend line in the 2008 meltdown, and have since, if you look at prices came back up, retested, failed, retested again, failed, retested again, failed. And what that has formed here, as prices are bouncing up underneath this uptrend line, is now you have this rising wedge. And again, we're looking at the monthly chart. So it's been my experience that technical analysis, stock patterns play out the same whether they're on a 1 minute frame, 5 minute time frame, 60-minute daily, all the way out to a monthly. They're just as valid, and you could expect, if this pattern did break down, it would almost certainly signal the fact that we're in the early stages of a new bear market. And of course, that's yet to happen, folks. But here we're at. Here we're at right now. Prices are in this. I have a resistance band here, resistance zone. This upper trend line. You have a candlestick wick down here, a tail or a wick, a tail, and some price highs over here. So we're really at horizontal resistance and working towards really getting very close to the apex of this wedge. So if this thing is going to break down, I would expect that it does so soon here within the next few months. And take a look at the weekly chart, nothing there. Okay, daily chart. Again, now we've covered so far the SP 500, we've covered the NDX, the NDX 100, and now, or I should say the NDX equal weight, and now the Nasdaq. This is a daily chart of the Nasdaq Composite. Same story here. It's a very clear downtrend line with 1, 2, 3, 4, 5, and now we're right at about the 6th candlestick tag of that downtrend line. Prices are right there. I mean, we closed, we pierced through it intraday, but it's a daily time frame chart, so we didn't close above that trend line, and that's where we're at. So again, looks like we're in a pretty key technical level across all the U.S. markets, and this looks again like a symmetrical triangle pattern. Respect this thing whichever way it breaks. Here's a key support line below, and I'll update some of these. I'll keep these posted. The 60-minute charts, I'll keep those updated. Or I should say, I'll keep those 60-minute charts updated for the micro support levels for the more active traders. Okay, as I was not gifted with the, or blessed with the gift of brevity, I see you have now crossed the 20-minute mark, so I'm going to wrap this up pretty quickly. Just a quick look here are the some of the key overseas indices. Here's the Paris CAC 40 index, and if you take a look, nice downtrend line here. 1, 2, 3. We're now at the fourth touch. That is a key primary downtrend line. This keeps the downtrend intact. We could punch through that line until you take out the previous high. We still have a series. A downtrend is defined by a series of lower highs and lower lows. And this is more similar to the U.S. markets, as I've showed, where we sort of have, you can look at this uptrend line here, that's sort of a triangle pattern, not as clear as some of the U.S. markets. But either way, respect this downtrend line, keep an eye on it, and if this previous high were to be taken out, that would then put the current downtrend in jeopardy. So watch this downtrend line, but you still have a little bit of room to go before one could say that the that index is no longer in a downtrend. Okay, let's look at the German DAX, and another key downtrend line. I colored this one orange. 1, 2, 3. We have a little room to go there, so not much to say on the DAX. The DAX could push up a little and still comfortably be well within its downtrend line. All eyes, of course, are on China, and this is the SSEC, Shanghai Composite Index. And let's see here. I should have some trend lines. I don't know why they're not filling in. Anyways, I've put this chart up in the past. Here they go. This one has been stair-stepping down over time, and you can take a look here at how well. I mean, this is, talk about a trader's market. These downtrend lines just clearly mark, how this index has been stair-stepping down. Once these break, just about every one, if you look at this one, you go long on the break of the uptrend line, the downtrend line, I'm sorry, you catch a nice uptrend, which then can be defined by a pretty clear uptrend line. So you basically go long, short. Long on the downtrend line breaks, short on the uptrend line breaks, and that has worked all along. You had one little fake out here. If you look where my cursor is, prices went down only for a few days, and then boom, right back up again. And so that was about the only whipsaw we had in here. And as you can see, it's just been almost textbook. And right now, I will point out, this downtrend here is getting a little bit long in the tooth. If you look at the length of these previous downtrend lines here, this one was a little bit longer, but this one is one of the longer ones on there. Something I should point out, there's quite a bit of divergence in place here. This MACD is not making a lower low as prices are, so keep an eye on China. This one, if the U.S. markets do break to the upside, I still do maintain my overall bearish bias right now, but I'm completely open to any possibilities. If the U.S. markets want to break to the upside and go, I think China probably has quite a bit of run, even for a short-term trade. A trader could go long on the break of this downtrend line. You can't trade the SSEC directly, but you can trade the PGJ, I believe, and the FXI are two of the more commonly traded Chinese ETFs. They don't track this index directly. They track some Chinese companies, so they'll roughly mirror it. And let's move on here. Hong Kong, Hang Seng, nothing major. Actually, I didn't even mark this one up before today, but let's just extend this trend line out here. It has a ways to go. Of course, it's still in a downtrend as well. And the FTSE, And as you can see, the London FTSE is well within its downtrend line as well, so not much to say on there. There's plenty of room it can push up and still remain even under this downtrend line. Once it breaks above that, it's not too far away from its previous reaction high. Okay, currencies, let's take a look at the euro versus the US dollar, and I'll jump out to a 2-day chart. This chart's a little busier than I usually put them up, folks. I apologize for that. One of my pet peeves are those charts you see out there with 1,000 different trend lines and Fibonacci retracements and everything. This one, I've left some of these lines up. I'll probably clean this one later on, clean this chart up. But you look here, here's a downtrend line. Let's just focus on this one here. We've had a couple price points here. Prices recently caught that trend line there, and we've bounced since then. Probably should clean this up a little bit. Positive divergence in place. I'm going to jump over to a daily chart here, and here's a bullish falling wedge. This line on the top, this trend line on the bottom. Your positive divergence is right here. MACD making a higher low against prices on right here making a lower low. So there you have pretty strong positive divergence in place on this bullish falling wedge. And I will tell you, this chart, these currency charts, are the one thing, probably the single most thing giving me pause right now on my overall bearish bias. Now we can see this chart break out. First of all, let me back up. This doesn't have to play out. Sometimes you'll have a nice bullish falling wedge or a bearish rising wedge with beautiful divergence in place, and it doesn't have to play out. With that being said, if it does break to the upside and moves up, it is possible the stock market can fall. The U.S. stock market can drop with a rising dollar. We can see this, a rising euro. We can see a disconnect. We've seen it in the past there. I'll probably do a little bit more on the currency charts later on. But with that being said, I'm a big fan of divergences. Here was nice positive divergence in place. If you look at this line here, this brownish color line against this one, and that led to this breakout here. I had a down channel and a wedge. If you use this line and this upper line, prices broke out, and we had quite a move, and it lasted for a couple months there. So we're looking at that in place right now. So keep an eye on that as well. Final chart, and give you my word on this. I know this one's running over. Let's take a look at the US dollar. Very similar chart. Let's look at my weekly chart. This is a downtrend line that I've been looking at for a long time. We had a key. This line goes back even further. If I zoomed out to a monthly chart, here's a long-term downtrend line on the dollar, which was broken back. Here, the dollar has, in my opinion, been basing since, and this is another key downtrend line. This yellow downtrend line, something to keep an eye on. I'm not sure if we're going to get that far before prices break out, but if you look here. This is the US dollar index. We have this rising wedge, a bearish rising wedge with negative divergence in place on this one. We have horizontal resistance right here, which price has recently just pierced through but fallen back below. Again, if that euro chart I just showed, if that bullish falling wedge breaks out, obviously this US dollar chart is going to break down, the dollar is going to fall, which tends to be bullish for stocks. So something to keep an eye on. However, if these patterns do not play out to the downside, if the US dollar continues to push up, burns through these divergences, which is a possibility, keep an eye on this key downtrend line here, because this looks like a huge base building in the dollar, a multi-year base. And if that base were to break out, see, there's the long-term downtrend line. Oh no, that's a monthly chart. If that base were to break out, the dollar could shoot up, and that's something to watch. That would probably happen if we did see a pretty big meltdown in the U.S. markets. Okay, folks, that's it, and I'm going to cut this short just to the 30-minute mark. I'll try to keep these future video updates a little bit shorter.